Welcome to all of you who are here today to see Governor Lael Brainard present, and I can't tell you how thrilled I am that we are hosting her and get to hear from someone who is so on the front lines of policymaking in DC. Before I get to an introduction for Governor Brainard, I want to tell you a bit first about a few events that we have coming down the pike. This is by no means an exhaustive list, but it's some of what we have on the horizon. So this Friday, we have a conference with the title Powerful Tools, Innovation Challenges for the Next President, which I think will be a great day from late morning until mid-afternoon. I think that's going to be a lot of fun. On January 19th, we have our next associates event with David Yoffie from Harvard Business School, and he will be, I think that will be, we have many more of those coming down the pike, and perhaps most important of all, on March 11th, Friday, March 11th, we have our next economic summit. And there we're going to hear from a broad set of people, including Jean-Claude Trichet, who's chairman of the Group of 30, Max Baucus, who's ambassador to China, and many other people. And we're going to have a session on NBA basketball as well with two NBA owners, Steve Ballmer and Joe Lacob. And I guess the question will be then is, are the Golden State Warriors 55-0? At that point, and so I guess we'll get to see at that point. That should be interesting, given their current trend. So in any case, let me just do a quick introduction for Governor Brainard. I can't come close to doing justice to all that she's accomplished during her professional career, but I'll just take a few snapshots of some of her background. So she is a graduate of Wesleyan and of Harvard University, and she's someone, one thing that we try to do at SIEPR is bring together people from the academic world, from the business world, and from the policy world, and Governor Brainard is someone who's excelled in all three of those orbits. She's worked as a faculty member at MIT, as a consultant at McKinsey. She's directed the Global Economy and Development Program at the Brookings Institution, and over the last several years has been very involved in DC as the Undersecretary of the Treasury at the U.S. Department of the Treasury, and most recently as a member of the Federal Reserve Board of Governors. And the list of accomplishments and appointments and so forth just goes on, and I am really truly honored that it worked out for her to come here today and talk about her insights on recent economic and financial developments. So with that, please join me in welcoming Governor Lael Brainard.
That was very nice. So I want to first thank Mark for inviting me. It's really a pleasure to be here at Stanford today. Let me just begin by noting that my comments today will not address the timing of liftoff for the federal funds rate. So recent months have seen increased anticipation of the normalization of monetary policy in the United States. Many observers interpret normalization to mean a tightening cycle, similar in pace to previous cycles, such as those in 1994 to 95 or 2004 to 2007, with the effect of returning interest rates to the level viewed as normal in the decades before the crisis. In fact, the Federal Reserve describes normalization as steps to raise the federal funds rate and other short-term interest rates to more normal levels. But what do we mean by more normal levels? A broad deterioration in foreign growth prospects, together with greater risk sensitivity in the wake of the crisis and changes in the rate of potential output growth, may be contributing to a new normal. That new normal is likely to be characterized by a lower level of interest rates than in the decades preceding the crisis, which in turn counsels a cautious and gradual approach to adjusting monetary policy. The appropriate benchmark for the pace and the target for normalizing monetary policy is the nominal neutral interest rate, the level of the federal funds rate that's consistent with output growing close to potential, with full employment and stable inflation. As all of the freshmen in this audience know, when the federal funds rate is below the nominal neutral rate, monetary policy is accommodative, and when it's above it, it is contractionary. So for that reason, many monetary policy rules, such as the one named for a very famous professor in this room, the Taylor rule, incorporate an estimate of the neutral real interest rate as a critical parameter along with the target rate of inflation. Although the neutral rate is a very important benchmark, it changes over time in response to important changes in economic conditions. And that in turn necessitates corresponding adjustments in monetary policy in order to return the economy to full employment. So if you think about cases where there are very modest adverse shocks that lead to modest reductions in the shorter run neutral rate, monetary policy can easily adjust to that. A lower nominal federal funds rate allows full employment to return. But when those adverse shocks to demand are sufficiently severe that the nominal neutral rate would require a nominal federal funds rate to go substantially below zero, then monetary policy confronts what we always call the zero lower bound constraint. That, of course, was the case here in the United States for several years following the crisis, and it remains true today in a number of advanced foreign economies. That's why monetary policymakers in the United States and several other major economies have been compelled to use additional unconventional tools, such as forward guidance and asset purchases. The neutral rate of interest cannot be directly observed, but we can back out an estimate of it by relying on the observation that output should be growing faster relative to its potential the further the federal funds rate is below the nominal neutral rate. So in today's circumstances, the fact that the US economy is growing at a pace that's only modestly above potential, while core inflation remains very restrained, suggests that the nominal neutral rate may not actually be far above the nominal federal funds rate, even now. In fact, there are a variety of econometric estimates of the level of the neutral rate that are consistent with relatively low levels suggested by this simple heuristic approach. So as we think about the policy path ahead, the critical question is whether a low neutral rate is likely to be a new normal in the longer run, or whether the neutral rate is likely to soon return to the levels that were normal before the crisis. And in trying to get at this question, there are a variety of things that economists look at. So for instance, we look at economic forecasts. Blue Chip Forecasts publishes projections of the federal funds rate and consumer prices, the CPI, 6 to 10 years into the future, when the economy is typically expected to be at full employment. The implied Blue Chip consensus longer run real federal funds rate averaged around 2.2% in the 2 decades preceding the crisis, which is also close to the level of the intercept term in the Taylor rule, which in turn is based on econometric results over the period from the mid-'80s through the mid-'90s. Today, the Blue Chip consensus longer run rate is about 1.1%, which is a full percentage point above what we saw in the pre-crisis period. Similarly, although the FOMC doesn't actually publish a projection of what normal is, the central tendency, or the median, of the longer run level of the federal funds rate that is published in the Summary of Economic Projections of the members of the Federal Open Markets Committee is a good proxy. Here too, by this proxy, forecasts of the neutral rate have moved down noticeably over the past several years. So if you look when this set of projections was first published in January of 2012, the median projection of the longer run level of the real federal funds rate was 2.25%. If you look at the most recent, in September, that number has now fallen to about 1.5%, which is a decline of about 0.75 of a percentage point. Market measures of expected forward rates evidence a similar decline. So for example, if we back out an implied 1-year real rate 10 years from now from the TIPS yield curve, the Treasury Inflation Protected Securities yield curve, the most recent readings are around 1.3%, 2 percentage points below the average rate in the decades preceding the crisis. Swap prices tell a similar story. And finally, there are some econometric models that we can look at that are used to estimate the current neutral rate or closely related concepts, which can be used to assess whether current low neutral rates are likely to persist. And here too, if you look at, for instance, a recent paper by Laubach and Williams, you'll see also that the natural rate, a very closely related concept, likely will remain near zero for several years into the future. So that, of course, raises the question of what factors might have caused the neutral rate to fall and how persistent they're likely to be, because we need to, in monetary policy, be forward-looking. Let me just quickly touch on a few factors that could lead the neutral rate to remain depressed in the longer run, ranging from the low level of world interest rates, which affects the United States via the exchange rate and financial market channels, to slow-moving secular trends in the labor force and productivity, to persistent changes in risk perception stemming from the crisis. So first, although tight domestic credit conditions and concerns about downside risks to asset prices and domestic demand were probably dominant early in our recovery, the foreign outlook has become increasingly important as a source of downward pressure on the neutral rate in the past few years. In addition to concerns about weak demand in Japan and the euro area, more recently, foreign growth concerns have broadened to include China, which is navigating difficult structural as well as cyclical adjustments. The financial reverberations from China, in turn, are adversely affecting commodity exporters and emerging markets more generally, and weak growth trajectories are now the norm in much of the world, pushing down interest rates globally. So what does that mean for us? Well, the broad-based reduction in interest rates in the rest of the world by increasing demand for U.S. assets puts upward pressure on the dollar, which in turn implies downward pressure on the U.S. neutral rate. So one way to think about it is how much adjustment in the federal funds rate might be necessary to insulate domestic U.S. employment from an appreciation in the dollar that's expected to persist. So let's take the roughly 15% real appreciation of the dollar that we've seen since June of 2014. According to the board's FRB US model, it would require lowering the path of the federal funds rate roughly by 1 percentage point over the medium term to insulate domestic employment from a 15% stronger exchange rate. In the neighborhood of the zero lower bound, this shift down implies a delay in the date of liftoff and a shallower path for the federal funds rate over several years. So in effect, the spillover from abroad implies some limitations on the extent to which US monetary conditions can diverge from global conditions. Now, going forward, many observers might expect global growth to stabilize and eventually move higher, which would then in turn ease pressure on the dollar and on commodity prices and lead to a higher neutral rate globally. However, since many of these foreign economies are facing structural challenges as well as cyclical challenges, the speed at which that stabilization and recovery takes place is highly uncertain, and there's a risk that this influence on our neutral rate could fade very slowly. And of course, there are also downside risks to the foreign outlook. Other factors likely pushing down our neutral rate may prove even more persistent. Expectations that the economy's growth potential has fallen could contribute to a persistent decline in the neutral rate. There's evidence, for instance, that growth in the labor force and perhaps productivity have slowed persistently in recent years. After increasing noticeably in much of the post-Second World War period, the labor force participation rate flattened out over the 1990s and began to decline in the early part of last decade as the baby boom generation approached retirement. Most recently, the pace of that decline has quickened, with the participation rate declining 0.5% per year on average over the recovery. Productivity growth has also slowed, averaging just 1% per year over the recovery, which was about half the rate that we saw over the previous 50 years. And as a result, the CBO now estimates that the growth rate of potential output is only 1.7% currently, again, less than half the rate we saw in the preceding 50 years. Of course, although there is evidence of a connection between low potential output growth and a low neutral rate, the relationship is not actually precisely estimated, so we're not actually sure what that magnitude might be. And finally, it's worth just briefly considering whether investors' risk sensitivity may have been altered by the experience of tail risk during the crisis, which too could have a persistent depressing effect on the neutral rate. So to the extent that investors or firms are more attuned to the risks associated with their capital investments than before the crisis, it increases the premium that they demand for risky investments, or the difference in return between a risk-free investment, such as overnight reserves, and somewhat riskier investment opportunities. Put in the reverse, a higher risk premium necessitates a lower risk-free rate to encourage the same amount of risky investment. Consistent with this explanation, there's evidence that the gap between the return to capital investment and the risk-free rate has risen. So finally, before turning to what a persistently lower neutral interest rate might mean for the normalization of monetary policy, it's important to briefly review inflation developments. Because the federal funds rate is the real rate plus the expected rate of inflation, and because it's the real rate that influences economic activity, the amount of accommodation represented by a given nominal level of the federal funds rate decreases as expected inflation increases. In a low neutral rate environment, it's especially important to guard against extended periods of below target inflation, which may lead inflation expectations to drift lower. It's thus notable that inflation has been below our 2% target for nearly 3 years. Current below target levels of inflation in part reflect disinflationary pressures from abroad, including lower import prices and lower commodity prices, which are likely to prove transitory and fade over time. However, even excluding energy prices, inflation has been stubbornly low. So if we look at core personal consumption expenditures over the 12 months ending in October, core PCE prices, which exclude volatile categories of food and energy, increased 1.3%, and the 12-month change in core prices has been very little different from that level, around 1.25% to 1.5% now for the last several years, since the beginning of 2013. The persistent weakness in core price inflation deserves continued vigilance. In determining the outlook for inflation, the gravitational force of long-term inflation expectations, of course, is especially important. There, too, some survey measures of inflation expectations have declined recently. So if you look at the University of Michigan surveys, the median measure of inflation expectations at a 5 to 10-year horizon dropped to 2.5 and then 2.6% in the last 2 months, and has averaged 2.7% over the past year, slightly below the average reading over the past decade and in the low end of the range historically. Similarly, projections from the survey of professional forecasters also suggest that 10-year ahead inflation expectations edged lower this quarter, although they've remained at or very near 2% since the end of 2012. Market-based measures of inflation compensation at longer-term horizons, such as inflation swaps and the difference between nominal and inflation index treasury bond yields, have declined more noticeably over the past year and a half. It's difficult to precisely disentangle what is contributing to that, whether it be changes in inflation expectations, liquidity premia, and inflation risk premia. But some decomposition suggests that while expected inflation may not have declined much, market participants may be placing a somewhat greater likelihood than previously on episodes of below potential growth being accompanied by below target inflation. For that reason, the decline in measures of inflation expectations warrants close monitoring. So putting those two things together, the slow progress on inflation together with the likely low level of the longer-term neutral rate and the slow pace at which today's very low shorter-term rate may move to the longer-term rate suggests the federal funds rate is likely to adjust more gradually and to a lower level than in previous expansions. In short, gradual and low is likely to be the new normal. In addition, the combination of a low neutral real rate with slow progress on inflation suggests a greater likelihood of hitting the zero lower bound than in previous decades. The lower the longer run nominal neutral rate is, the smaller in magnitude you'd have to have of an adverse economic shock to push growth sufficiently below potential to necessitate the nominal federal funds rate again moving below zero to provide the necessary accommodation. Assuming that the severity and frequency of shocks is not much different than it was before the crisis, that means that the probability of being constrained by the zero lower bound is greater than prior to the crisis. Now, of course, we've seen a lot of experience with unconventional tools in the last few years. And although the empirical analysis so far suggests that unconventional tools affect the economy through the same channels as the federal funds rate, nonetheless, there are greater costs and uncertainties associated with unconventional policies. As a result, policy is likely to remain more constrained at the zero lower bound than above it. So as the probability of hitting the zero lower bound increases, the asymmetry in our policy flexibility becomes more pronounced. We have more space to respond by raising rates if inflationary forces accelerate than by cutting rates if disinflationary forces emerge. Then when nominal neutral rates are likely to be lower on average, we should just be somewhat more cautious about the path of rates, raise more gradually, and carefully assess the effects on economic and financial conditions as we go. Moreover, because the Federal Reserve's asset holdings help to maintain accommodative financial conditions, it would be prudent to maintain reinvestments until the normalization of the federal funds rate is sufficiently far along to allow room to cut nominal rates if economic conditions deteriorate. The asymmetry of policy flexibility at the zero lower bound also intensifies when there's some uncertainty about exactly what the neutral rate is. And of course, as I was explaining it to you, there is some uncertainty about the level of the neutral real rate. And under those circumstances, risk management considerations suggest again that policymakers should be somewhat cautious to signs that the neutral real rate may be rising. When there's uncertainty, there's always a risk that the actual neutral rate is either higher or lower than current estimates suggest. And then in that case, the stance of policy is actually more accommodative or contractionary than is intended. In cases where the actual neutral rate is higher than estimated, so that policy is more accommodative than it should be, the stance of policy can readily be tightened to restrain any buildup in inflationary pressures. But if the reverse is true, unexpected policy restraint may prove difficult to offset later with more accommodative policy, again, because the policy rate is already so close to the zero lower bound. And finally, there's also a risk that with persistently lower neutral rates, there may be greater pressure for investors to reach for yield, increasing the demand for risky assets. As a result, macroprudential policy takes on greater importance to guard against financial stability risks. And as many of you know, since the crisis, we and other regulatory agencies have implemented a number of new rules to strengthen capital, liquidity, and risk management, especially at the largest financial institutions. Many of those are through the cycle safeguards, but in addition, when the risks to financial stability appear to be rising, the Federal Reserve, in conjunction with the other banking agencies, can also temporarily increase the amount of capital that the large banks are required to hold in order to build resilience and to restrain undue risk-taking on a cyclical basis. So just to conclude very briefly, a variety of evidence suggests that the longer run neutral rate is longer now than it has been historically, and that the very low, shorter run neutral rate may adjust to it very slowly due to a combination of weaker foreign demand growth, greater risk sensitivity as a result of the crisis, higher risk premia for productive investment, and lower growth in potential output. The lower neutral rate means that the normalization of the federal funds rate is likely to follow a more gradual and shallower path than in previous cycles, although, of course, the actual path will be determined by economic conditions. It also implies that the likelihood of the federal funds rate hitting the zero lower bound will be persistently greater than it has been previously, which could make it more difficult to achieve our objectives of full employment and 2% inflation. Under these circumstances, the asymmetry in risk management considerations counsels a cautious and gradual approach. So thank you, and with that, shall I come and have some questions? Thank you.
So thanks so much for those insights. I'm just going to throw out one question for you and then open it up to the audience, many of whom are colleagues of mine, students and supporters, friends of SIEPR. But so as you know, it's interesting. We've had over the last 7 years interest rates quite low at these very low levels, and during that same time, there have been some pretty dramatic changes in the labor market. So if you look back, went to the BLS website right before this event to get the most up-to-date data on this. So if we look back 6 years ago, the unemployment rate in the US was 10.0%. And last month, the most recent jobs report indicated that the unemployment rate had fallen to 5.0%. So huge reduction over this period, a very large change. But then if you, instead of searching for BLS unemployment rate, if you look for BLS employment rate, and we basically say, let's see, what fraction of the population is employed? During that same period, the uptick has been much less pronounced, from 58.5% to 59.3%, so less than a 1 percentage point increase during that time period. You alluded a bit to labor force participation and sort of the trends and the acceleration in that. But as you look to the health of the labor market in the U.S., to what extent does the unemployment rate, the employment rate, the labor force participation rate, wage growth, and so forth, how do you sort of aggregate all those and think about the health of the economy?
So you're probably better suited to answering some of those questions, but I will tell you that we spend a lot of time looking not only at the aggregate unemployment rate, but really trying to understand in a much more granular way what's going on in the labor market. And as Mark said, there are some puzzling facts there that bear continued examination. So on the one hand, I've been very heartened by the cumulative progress, the cumulative and very substantial progress that we have seen on the unemployment rate. And I think if you had looked a few years ago, people's estimate of what the natural rate, the equilibrium rate of unemployment, or the rate of unemployment at which inflation would not be accelerating would be, many were assuming that it had actually should have risen as a result of the crisis. And in fact, what we have seen in the continued progress on the overall unemployment rate is that margin of labor market slack has diminished quite considerably at a time when it's so far we are not seeing the same kind of progress on measures of compensation. And so there's a little bit of a puzzle there as to what is compensation telling us about whether there are still margins of slack in the labor market where there may still be some room to go. Earlier in the recession, the long-term unemployment rate was quite elevated. It took quite a bit longer for that to start moving downward, but there too we've seen recent progress that's very heartening. We've also seen some progress. We had a very elevated rate of workers who were working part-time for economic reasons, who would have preferred full-time jobs. That rate has been quite elevated through much of the recovery, and there too we're seeing some progress. Where I think still puzzles have not been answered is why is the employment to population ratio still depressed relative to where we were pre-crisis, and what are the underlying factors that may be affecting the labor force participation rate. There too, I think we were seeing, perhaps a few quarters ago, later last year, there seemed to be some improvement on the labor force participation rate that suggested there was some cyclical room to go. And more recently, the labor force participation rate has again resumed its decline. So I would say the set of labor market indicators are extremely important to us for judging how much slack remains in the economy. My judgment is there's still some room to go, but the reality is that overall unemployment rate has made very substantial progress.
Great. Okay, I'm going to open it up for questions. Barnaby. No, you're not allowed. I get into trouble if I let you do that.
Going here? Where are we going? Okay.
George, I think, yeah.
Hi.
Great.
So I asked you this in the lobby. It's a little upsetting because I think there's two institutions in the U.S. that really have a lot of respect, where people have a lot of respect for. One is the Supreme Court, and one is the Fed. At this point, there's a number of people who think that, a couple of statements, that feel that the Fed maybe had an opportunity some months ago to have raised rates and didn't do it, and now kind of back in a corner. So there's some feeling that maybe there's a little bit of a challenge to them, maybe a little bit powerless, being backed into a corner. But there were two primary things that happened under the Bernanke Fed. One was lowering interest rates, and the other one was several quantitative easings, which raised the debt load from $600 million pre-crisis to something in the area of $5 trillion today. Nothing's being said or done about letting that balance sheet roll off, even through something as simple as as they mature, letting them go back and slowly reducing that, so you could take a more proactive stance to, I mean, you've got a perfect opportunity right now with interest rates low, with the currency strong, with a lot of demand for our debt. Why not take this opportunity aggressively and proactively to get rid of the balance sheet that the Fed now has and get more into a stronger position? Why not do that?
So as I was describing earlier, during the crisis, prior to the time when I was on the Federal Reserve Board, the monetary policy makers confronted the classic problem that the neutral real interest rate, the interest rate that was necessary to restore the economy to full employment and to target inflation following extraordinarily severe shocks to aggregate demand, for instance, the very large shock to wealth and the consequent shock to consumption that came from the housing bust, that in order to provide the requisite amount of accommodation, then the nominal federal funds rate would have had to be able to go substantially below zero. And so the alternative to that, when confronted with a zero lower bound, is to engage in unconventional policies such as asset purchases and forward guidance. And again, there's been a lot of empirical work that's been done in this area, which has suggested that in the United States and in some of the other countries that have undertaken these kinds of policies, that those policies do operate through very similar channels and do help to provide accommodation. The Federal Reserve, the Open Markets Committee, as they have talked about and provided statements to the public on how they're going to pursue normalization, they have included as part of their normalization principles a discussion of reinvestment in the assets held on the balance sheet and the role of that relative to the path of normalization for the federal funds rate. And again, it's important to think about our monetary stance as comprising not only the level of the federal funds rate, but also the size of the balance sheet. And the reinvestment principles, I think, try to do a very good job of explaining very transparently to the public how those two things will operate. As I just said in my remarks, I think it would be prudent because the level of the nominal neutral rate is very low, is likely to move higher only gradually, and is likely to be at a lower level in the longer run. It would be prudent to maintain reinvestments until that process has proceeded far enough to allow more room for the federal funds rate to be reduced to provide accommodation if conditions should deteriorate. But again, the policy decisions, the size of the balance sheet and the pace at which it runs off and the path of normalization for the federal funds rate, those are policy decisions that are made in conjunction as part of the broader stance of monetary policy.
Great. Next question. Michael Boskin.
Thanks. Alan Greenspan used to describe monetary policy as risk management. you've talked a little bit about that, and you've laid out kind of a base case and being data dependent and normalizing more slowly relative to a view that potential has declined and et cetera, et cetera, et cetera. And you quoted blue chip and a variety of others. So one thing to think about, and it'd be interesting to hear your perceptions of us, what if some of those things are wrong and they happen more rapidly, and what you're likely to do? And I want to phrase it this way. When the blue chip forecaster estimated, when the funds rate got to 0, the blue chip forecasters forecast it would last 6 months at 0. We're now at 7 years. Okay, so I wouldn't put a huge probability on that forecast being right. It may be a reasonable central tendency, but there's got to be a lot of variation around these things. Productivity's collapsed in the recession, and well, maybe mean reversion to previous times might be an exaggeration. A lot of this decline in potential, some of it may be fairly predictable labor force participation, but it's a lowering of productivity estimates. So if we see this happening and growth rebounding abroad and so on, you're then in a position in your base case, as you start to see this, to see a low funds rate, a large balance sheet, and the prospect to exaggerate, this isn't what I believe will happen ever probably, but anytime soon, if the money multiplier and velocity return to their pre-crisis level, the price level would triple, given the size of the balance sheet. So you're going to have to stop that from happening on relatively short notice. You're going to have to do something about not having all that stuff lent out at too fast a pace in this scenario, which is one of many. There could be a downside scenario too. And then what the Fed has done, starting with Bernanke, has said, well, we can always raise interest on reserves. But if you have to start raising the funds rate to, say, 3% over a relatively modest time frame, you're going to be giving tens of billions of dollars to banks. Now, your first step, if you might get away with it for 6 months by saying that we made a lot of money previously, so we're still way ahead. But that's just not politically sustainable. So how do you guys think about that scenario and how you navigate it?
So I think the way that you framed it is a very kind of important one for how certainly I think about the set of decisions that confront the committee. It really is a set of risk management considerations, and there are risks on both sides. There are risks that the neutral rate moves higher and more quickly than a variety of econometric estimates and current forecasts and underlying economic forecasts might suggest, or economic forces might suggest, in which case it would necessitate a more rapid removal of accommodation. And I laid out that there's also a set of risks on the other side, that potentially the lower neutral rate could be quite a bit lower than it has been historically, that it may move to that rate quite slowly, that we've seen somewhat below target inflation over a fairly protracted period of time now, and that the policy space for addressing that set of risks because of the zero lower bound may be more constrained. But I would say that certainly I am, and I know other members of the committee are extremely attuned to both sides of that risk proposition. And there is more room to respond, both through the balance sheet policy as well as through the path for the federal funds rate if inflationary pressures turn out to be much stronger. But of course, we would want to be extremely cautious so as to continue to nurture the recovery. So I would not downplay the importance of those risks. I would simply say that our policy toolkit is quite asymmetric for dealing with those two different kinds of risks. And again, there are a variety of reasons to believe that the economy will, for some time, be buffeted by forces that may warrant a somewhat slower, more gradual increase in the neutral rate. forces emanating from abroad, changes in risk perceptions pursuant to a very severe crisis, as well as the rate of potential and productivity that you pointed out.
Okay, thanks for the question. Professor Taylor.
I really appreciate your going carefully over the various considerations in the equilibrium interest rate, but it strikes me that there is just an incredible amount of uncertainty about that. And you mentioned how the FOMC has gone down by 75 basis points in really less than 3 years in their estimate. And economists are all over the map on that. I mean, we hear it talk, some people say it's -6, some people say it's 4. It's just, and it sounds to me as a little danger that so much of monetary policy is being dependent on that estimate now. You know, for many years, we assumed it was 2%. And it worked pretty well. And now, that seems to be the major factor that you're considering in the liftoff and the pace of the liftoff. So it's a concern. I just wanted to ask you about that issue.
So I think when, and again, each member of the committee kind of formulates their views in slightly different ways, although they are shown in the summary of economic projections, and so you can take some signal from the central tendency or the medians of that. But when I, am trying to think about how to gauge what that benchmark might be for the underlying rate of interest, some very simple observations help to inform whether the estimates may be kind of more or less accurate. And the observation that we have been at the zero lower bound with a very substantial amount of accommodation for a sustained period of time, but that we don't see any kind of movement in inflation back to our target at a more accelerated rate is also a very important piece of feedback from the economy that we've got to keep looking at very closely. The core price, now there have been a variety of forces that are likely to be transitory, oil prices, for instance, some of the restraint that's coming through import prices likely to be transitory. But the fact that core has also, and core on the services side has been low for some period of time, is a fact that that certainly I look at very carefully, along with the survey measures, which are at the low end of the range, and we've seen a little bit of deterioration. And the market-based measures, I think, have moved notably lower over the last 12 plus months. And that's another area where that gives us a little bit of feedback as well as to whether the neutral rate may actually be still somewhat lower. But the observation that we cannot precisely measure this does lead to a great deal of caution in how much inference we can take from that. And again, I think it's important to kind of reiterate that the actual path of policy is going to vary in response to economic and financial conditions.
Great, thanks. Next question. Monica, Professor Piazzesi.
You mentioned higher risk premia as one of the reasons why the federal funds rate may stay lower in the future. I would be interested in how you think about what drives these high risk premia in financial markets and whether there's something that the Fed could actually do something about.
So I think the observation is simply comes from a variety of both econometric, some DSGE models that the New York Fed and the Federal Reserve Board have used, as well as some broad observations about certain relationships of various risk premia in the markets. That's something that seems to be somewhat pronounced in the wake of the crisis. But to the extent you're asking, do we understand the underlying causes precisely? I would say no. I would say there's a set of relationships that seem to have changed. It seems to be pretty closely timed relative to the crisis, but the underlying drivers are not ones that certainly the research that I've seen, would lead me to have very confident conclusions about. But it does help to inform my views certainly about, whether the current low level of the neutral rate is, something that's likely to be somewhat persistent or move more rapidly back to something that might be more historically normal.
Great, thanks. Next question, in the back.
Hi, I'm Harriet Torrey with the Wall Street Journal. I just wanted to ask a bit about the remarks you made in your speech about the strong dollar and the delay that implies in the date of liftoff. Do you favor raising interest rates in December?
So just to reiterate, really, the past year and a half, we've seen strong cross currents from abroad, a weakening of foreign growth prospects. Those initially, I think there was more focus on some of the advanced foreign economies, Japan and the Euro area in particular. But in recent months, we've seen those concerns broaden to include, importantly, China and many commodity exporting countries that whose own growth had been closely tied to Japan's demand, as well as some exporting emerging markets in the region who are important destinations for U.S. exports, who have seen diminutions in their growth prospects. Those things do spill over into the U.S. economy through all the kind of classic channels, through weaker export growth, through lower import prices. We see it through greater demand for U.S. assets, which puts downward pressure on the exchange rate. And so those spillovers do then mean that if you have a lower neutral interest rate abroad associated with lower growth, you're going to have spillovers through those channels into the U.S. economy, where you would see a depressing effect on the neutral rate here as well. And that has implications for the normalization path.
Okay, great. Next question. There, right there. Yeah, blue jacket.
It was mentioned earlier that employment rates have only nominally gone up by a couple of points, whereas unemployment has gone down by 5 points. It seems trivial, but one of those is wrong, or else we have some problems in the way the data is gathered. And I think it's the latter. I think these techniques are mostly sampling techniques, and so for unemployment, people are asked, do you have a job? And if you don't, are you looking for work? And if the answer to that is yes, then you're unemployed. And on the employment side, however, I can see some good reasons why people who are employed in the shadow market, in the internet market, in the gray market, might not want to say that they're employed, lest the next call is from the IRS. And so the question is, is the Fed sticking with the official sources of all of this information? Are they trying to get to the bottom of this riddle? Because it seems to be the major trigger determining an increase in interest rates.
So I will say that the issues that you're raising are, extremely interesting issues, and we have incredibly talented researchers throughout the Federal Reserve System who are looking, including at the Federal Reserve Board here in San Francisco, who are looking to try to get underneath some of the aggregate labor market statistics and better understand them. Of course, one of the questions that is of interest is, is the 1099 economy somehow showing up differently in the statistics. There used to be a contingent worker study that unfortunately was stopped at exactly the wrong time, right? So the BLS is no longer collecting that data. But I know there are some interesting academic economists that are working with some of the companies in this space to try to better understand what new patterns of employment, referred to as 1099, but internet mediated patterns of employment might imply. All of that, I think, is extremely important and interesting. We don't know enough, really, to fundamentally want to alter, the aggregate statistics. But I think it's an area where it is going to be increasingly important to kind of get underneath those aggregate statistics and better understand what's going on there. Going back, though, to the earlier conversation we had, I mean, there still is this puzzle that unemployment has, at an aggregate level, improved a great deal, and yet we're not seeing a commensurate increase in or acceleration in wages. And so one would expect to see it there, even if we're not seeing it on the unemployment statistics.
Okay, question? Yep, right here.
You've done a very good job laying out the problem of the asymmetry of the zero bound of nominal and interest rate and Fed rate, and also the debt overhang. There's been a third policy suggestion by Adair Turner from England that you could simply print money, that the time has come to print money which does not increase the debt overload. It actually will perhaps increase the natural rate of inflation and bring you out of that, away from that a problem of the zero. So I'd be interested in your thoughts about that as a time, that policy time may have come.
So I know there are a number of proposals out there that go beyond the policies that I was talking about earlier. I think we do have, the economy is improving nicely, especially on the labor market side. Again, I continue to be looking for more improvement on the inflation side. But, we do have quite robust tools already at our disposal, the federal funds rate, the assets on our balance sheet, as we navigate forward. So my own focus has really been on that set of conventional and pretty conventional, unconventional policies. And I think that, at least for me, will continue to be the main focus of where I think the path forward is likely to include.
Okay, right here.
Hi, thank you for your comments today. My question is as follows. So one of the old monetary policy adages talks about long and variable lags between raising rates and impacting the economy. Yet you've talked also about financial fragility, and I think the taper tantrum as maybe accelerated financial fragility and tightening, QE maybe is accelerated financial easing. Is it the case that long and variable lags don't apply as they used to in this world of QE and an elevated balance sheet and reach for yield? Or should we think about, how do you think about long and variable lags in setting policy?
So I think the paradigm that monetary policy operates with long lags but also variable lags continues to be extremely powerful. And it certainly has to be a dominant consideration. So as I think about the path forward, and as the committee is considering, the sort of longer path forward, understanding that the way monetary policy works is persistent, and that it's imperfect in terms of our measurement of it, and it is variable over time, means that we're trying to think about not just how the economy is today, but how expectations are being formed about where the economy is going to be in what we call the longer run once current shocks have died down, and all along that path. And so that's why inflation expectations matter a great deal as we think about this. That's why the longer run neutral rate matters. What is that normal that the federal funds rate is moving to over time? And then the persistence of some of the shocks that we're experiencing today. The adage that monetary policy operates with long and variable lags is very live, and that's why a monetary policy is complicated, and why communication about the path forward, the framework that the committee is using, what the target is, are all extremely important in helping market participants and the public have a similar reaction function, so that when new data comes along that helps to shape the outlook, market participants and the public understand how that data would shape the policy or would be affecting the policy reaction function to avoid having big changes in or discrepancies in how the market is interpreting a piece of data and how the committee is likely to interpret a piece of data.
Great, thanks so much. I know I didn't get to every question, but we're at 6:02 p.m., and so I think now is, as much as it pains me to do it, we should wrap up. So please join me in thanking Governor Brainard for coming out.